and they have 10 stocks, and then PMS is concentrated and they have 10 stocks. So if there are 50 people like that who have concentrated on 10 stocks each, unless some stocks are common, that means this group has collectively bet on 500 stocks. Let us say some stocks are common. So that means they are betting on 200-300 stocks. So how can they all do well? So what will happen is that the fund manager who does well will tell you his stories, and the fund manager who does badly will disappear and not be a fund manager. So this is no formula, this is a lottery. It's like I say that if you win a lottery, nobody comes and asks you, can you tell us how you chose the number? And then you'll say, I chose my birthday, and then I added my anniversary, and then I divided by 3. So everybody will say, oh, good idea, we'll also do the same. It's a lottery, and lottery is not a strategy.
What's the ideal number? I mean, what do you go with? 25, 30 stocks?
We go with 30 names.
30 stocks.
In which we go 10 big names and 20 medium caps, but they were in trouble and are coming out. For example, if you buy Indian hotels after COVID, now you can't make it a 5-7% position because the hotel is closed. There is no vaccine. There is no idea whether India will get a vaccine. But you still feel like you're buying it for, it's a survivor, it's part of Tata, it's not leverage, whatever. You can't buy 5-7%. But that portfolio of 20 stocks, all the multi-baggers come without your knowing that these will be, but you get a slightly higher proportion than others or the market. And that is how it has been. So I have got, other than some specialty chemical guys, literally every multi-bagger of this country, without knowing that it will be a multi-bagger.
But they all
by
started
buying 2%. Yeah, 2%. Whether it's Bajaj Finance, HDFC Bank, Kotak Bank, in the new life, Varun Beverages, or kuch bhi, but 2% se hota hai kaam. And then they go up whatever number of times.
What do you do when 2 becomes 10%?
No, we don't let it go to 10 because we are a fund. So new investors are coming in all the time. So 2 also doesn't mean 2 because if a stock is doing well, you can always add a little because now it's your stock. If 2 becomes 2.5 by its performance and you think everything is doing well, okay, then you add it. But one, I'm not buying 4 of anything. That's the idea. But we won't let it go beyond 4, 5.
Okay. What do you do with some of the old stocks? Citibank?
No, it's still our number 1 holding, and it will not be. It will be a star, I think, starting maybe this year.
Have you already seen signs of a pickup again? I mean,
no. You see, it's a technical issue also.
Yeah.
So the thing is that, of course, it's doing well. It's growing 18-19%. And it is very, very cheap. It's 1/3 the valuation of a Bajaj Finance. But the thing is, it's a technical issue. Once HDFC Bank and HDFC merge, we expect, based on these things that people put out, that $5 billion might be the selling just from index funds, because currently HDFC Bank is not in the index and HDFC in the index. When they combine, the whole thing will be in the index. Currently, 20% of HDFC Bank is owned by HDFC, which is counted as a foreigner owning it.
Okay.
Because HDFC is viewed as a foreign company, but it's not literally owned by FIIs. So that capacity will be released, you can say. So there are technical also.
In 75% to 80% on your financial side. So all we need is demand. We've got capacities, we've got the cost structures in our favor, and if we can get the growth, we can leverage that growth. Frankly, in my investing experience, while India has been an off and on cycle that you've seen, I haven't seen a formation of the cycle ever take place. So markets, headline, expensive, driven by a lot of companies that probably belong to a subset of businesses that got extrapolated over the last couple of years. The opportunity, should demand environment stabilize globally, I think we will feed into the rest of the world and do it very successfully in this cycle.
Right. Devina, you've been at pains over the throughout your investing career, particularly the late part of it, to say that the India story is good. You invest in it yourself. But it's never a good idea to invest just in India. You should have exposure to other kind of assets and other kind of geographies. Can you tell our audience why you believe, if the India story is so compelling, why do you need to look elsewhere?
Yeah. So for one, if you look at India, India is what? It is 3.5% thereabouts of the world market cap in equity markets. So what would be the reason to put 100% or 90% of your assets in a single geography? Every country, investors have a home country bias. Canadian investors have 60% of their assets in Canadian equities. Canada is not 60% of the world equity markets. But in India, that is very, very pronounced. And part of the reason is that historically we did not have capital account convertibility. Most of us in this room would remember a time when you could take out only $500 once every 3 years. So while now the liberalized remittance scheme allows you a very good amount, $250,000 per head per annum, which means in a family of 4, that's $1 million. People have still not really gotten around to thinking about global investing, or if they think of global investing, they think a NASDAQ ETF le liya and that's enough, which is not global investing. True global investing means looking at all geographies, all asset classes, and there are a few reasons for that. And I will go back to my personal history, which was the Asian crisis approximately 25 years ago, when in just 1 year, in dollar terms, the markets fell between 50% for Taiwan to 90% for Indonesia and, Thailand, South Korea, everybody in between. And, we talk of the India growth stories. These were not basket case economies. These were the Asian tigers. India wanted to be an Asian tiger. You wanted to grow at those growth rates. And yet, if you were an Indonesian investor, you would have seen your net worth wiped out by 90% in a single year. For me personally, that was a wake-up call. So 1999, we were the first Asian firm to become members of the London Stock Exchange, because I said, it's no time to be in a single market. And then the next year of the NASD. So that is where, crisis is one thing, but even without a crisis, when I started working in the 80s, the dollar was 12 rupees. Now you know where it is. So it's a 85% depreciation in the course of less than a single career. So when we talk of long-term planning, long-term financial goals, long-term asset allocation, you have to look at global investing. And that means over a period of time, at least 30% of your, if not more of your assets should be global. And more so now, most people in this room would have children studying abroad or planning to study abroad, or therefore children settle abroad. Maybe you even want to retire somewhere else. So those are all considerations you have to take into account. The old adage of not putting all your eggs in one basket, it is as simple as that. So while I say India will outperform, but this is not something I'm saying with a 1-year perspective. But longer term, you have to look at global investing. And again, if you just buy a single other market, even if it's the largest market, which is the US, that is improving things slightly, but that is still not global, because leadership changes in 2021 when there were all these NASDAQ ETFs and funds being launched. I was trying to tell people that this is recency bias. 3 years NASDAQ has been a great performer. You think it will last forever? Nothing lasts forever. No theme lasts forever. As I said, 2003 to 2007, we heard all these stories that US is over and now it's the decade of the emerging markets. 2010 to 20, when US was performing, those stories were forgotten. You might hear those stories again. But those are no theme, as I said, whether it is geography, whether it's asset classes, or within a country, the sectors, no theme lasts forever. So that is something you have to keep in mind. And 85 to 90% of your returns, first page of Investing 101, come from your asset allocation, not from security selection, whereas we spend all our time talking about security selection, which is the next multi-bagger. But get your asset allocation right, and that includes global diversification, true global diversification.
Ridham, I know you believe that India has been and will be the best performer among countries, but would you concede that there is a strong element of cyclicality that Devina is talking about? Or do you think that India is a far more structural bet than that?
No, I can't dispute the point that she makes. It's absolutely valid, which is from a portfolio perspective, diversification is key. You can't put all your eggs in a single basket. Unfortunately, I don't think most people have the expertise to go so diverse. So you will have to rely on professional fund managers, and as she pointed out, people just go and buy the ETFs because imagine selecting stocks in India itself is a tough job. Now imagine selecting stocks in 25 different geographies or doing other asset classes. So all these requires a lot of deep expertise.
But there are lots of products which are being launched.
Yeah, so you'll have to then go and buy products. I don't think there's much dispute on what she's saying. It's absolutely spot on. I mean, it's like putting all your money in a single stock. Is that good investing? No, it's not good investing. So single geography, single stock, single fixed income asset, all of these are risky strategies. Now, of course, I do what I do the best, which I doubt whether I understand everything correctly, but that's my field of expertise. So I stick to that, but I can't dispute what she's saying.
Saurabh, you're a proponent of concentration rather than the kind of thought process we are hearing now, right?
So I think both concentration in India and concentration abroad. So courtesy the 18 years that my wife and I lived in London, we got 1/3 of our money abroad. And that's a concentrated portfolio of, again, very similar to what we do in India. We've invested our savings from our 18 years in the UK in global monopolies, companies whose products many of you are using, even as I talk to you, many of you are using some of the global monopolist product. High ROC, dominant franchises, compounding in dollar terms at between 15 to 20%. And similarly in India.
No, feel free to mention names as well. We are in a small crowd of friends.
So similarly in India. So if you take, say, an Apple or a Microsoft, I think Microsoft has been compounding at 15 to 20% now for the best part of 30 years. Just when I was starting to worry, because I've also been told by lots of people that you should constantly worry, even if you've invested in a great company. Worry is the name of is what you should do as an investor. Just as I was beginning to worry, they thankfully went and bought ChatGPT, right? So I'll worry a little less. But jokes apart, the global portfolio that my wife and I built is very concentrated. Similarly, the Indian portfolio that we keep harping about is very concentrated. By the same token, we have a small cap portfolio in India, similarly concentrated. And the sort of the creed I'm espousing, the story that I'm trying to convey to you is, as I think Robert Hagstrom wrote in the Warren Buffett portfolio in 1994. Robert Hagstrom wrote a remarkable book called The Warren Buffett Portfolio in 1994. He conveyed the point of view, Buffett's point of view, John Maynard Keynes's point of view, that in any country, you will have ups and downs. The business cycle is a permanent feature of modern economic life. In any country, you'll have ups and downs. But if you want to consistently compound your wealth, whether in America or UK or India or Japan or the Middle East, build a concentrated portfolio of high quality stocks and stay the course. Don't try to second guess the market. Don't try to pretend that you'll be second guessing Nifty kahan jayega, Nasdaq kahan pe jayega. If you build a portfolio of concentrated high quality monopolies at the global level, as Devina is saying, and at the Indian level, as we do, even if you do one of these two, you'll be fine. But I think what's devastating for most people, so my parents' pension in the UK, by the way, is run by one of these fund managers. That fund managers bought lots of tracker funds, and my parents' British pension. And these poor guys, right? Just imagine my parents' plight in UK. They've been retired for 10 years. Inflation in UK is 8%. Their pension portfolio compounds at 2%, right? And this is happening to millions of families in the Western world, right? They're being ravaged by their fund managers buying ETFs, pension funds buying ETFs, at a world where inflation is 8%. Now, the result of that, Udayan, is very interesting. If you see Nifty VIX, Nifty volatility is actually lower than S&P 500 volatility now for the last 5, 6, 7 years. And the reason for that, I suspect, is because America has become such an ETF market, active investor interest has diminished, which makes that market volatile when new information emerges. Our country, for better or for worse, hasn't yet got as ETF'd as America. The result that they're going to suffer from for many years to come unless there is enlightened regulation in America is the American market steadily becomes more volatile than ours. And that's where having a focused portfolio of high quality global names, Indian names, puts you in good stead. If you're living in India, carry on buying stocks here. But the mantra I have taken is 1/3 global, 2/3 Indian. And so far, then, in the last 2 years, my better half and myself have done just fine out of that.
Okay. Devina, this morning, in the first session, I asked the same question to Samir Arora. And he almost thumped the table and said, concentration is the biggest enemy of your portfolio. You seem to agree with that because you own more than 50 stocks in your portfolio. Saurabh has only 15. Why do you think that one should have a far more diversified portfolio?
Well, that's what the statistics show. I mean, people tell me that you picked Amazon at $12 and you picked HDFC Bank 1 year out of IPO. Tell me the next HDFC Bank, I want to buy it for my son or daughter and keep it for 25 years. I said, nobody has that crystal ball. If you did, you would find investors in the world who have invested, if not 100% in multi-baggers, 90%, 80%, some number like that. There is nobody who has done that. Warren Buffett says that if you take out my 8 best bets in 60 years of investing, you will find that I have underperformed the market. Because you cannot know upfront which are going to be those stocks which compound at those levels. If you would ask Jeff Bezos or Aditya Puri, they could not have told you that. So the only way to do this is to have a stock, a portfolio of at least 25, 30 stocks, chosen with care, with a system, and yet you will find that some of them will turn out to be duds. So as I say, first thing one thing which will really help your portfolio is that when you're making a buy decision, tell yourself I may be making a mistake. So that you don't stop yourself from acknowledging a mistake if that is the case. So if you buy 25, 30 stocks, yes, if you've chosen them carefully and if you are lucky, you will find 2, 3, 4, 5 which have done, which become multi-baggers. But do you know upfront which are those 5 and therefore you can buy only 5? No. And in a concentrated portfolio, also typically I find a lot of people, when they talk concentrated, it is not just the number of stocks.
Carry on.
Hello?
Yeah.
So then don't just buy 15 stocks. They buy it only in 2 or 3 sectors. So effectively, you do not even have that diversification to the extent of 15. Because those sectors move together, and as I say, no theme runs forever. Any theme you want to put, businesses and stock markets are 2 different things. You can pick up any sector and you will find stocks in the steadiest sectors which have not performed for 10 years, 15 years at a time. So that you have to take into account. And we believe in sectoral diversification. We believe in diversification in terms of securities. And we have backtested it. And always also remember that investing is a loser's game. So first thing you have to make sure is that you reduce volatility, you reduce drawdowns. That's what we tell our investors also, that 60% of what you pay us is for risk management, 40% is for return management. So ask your fund manager or financial advisor, what is your risk management strategy? Because the only way to win in this game is to make sure you don't lose big. So every conviction has to be held very lightly.
Kenneth, which of these 2 schools do you belong to? By the way, when you started your first answer, I think they're all cursing me because you started by saying, you can build a high quality portfolio with a 10 to 15 PE. And they said, okay, what next? And you proceeded to something else. I think that's the part they're interested in.
Okay, I've been on both.
Little louder, Kenneth.
My investing experience actually got built through through what Peter Lynch wrote in all his books, right? So one way to outperform indices is, there are 2 ways to outperform indices. One, you build a portfolio outside the index, so you take the breadth of the market. And the second way to do it is concentrate within the indices itself, okay? And both work. So I've had colleagues and I have a peer group who've done extremely well for a long period of time, and everyone has different styles. I think you've got to pick the style that works for you. Okay, and the longer you keep doing it on that style and the number of stocks that you're doing, I think you will just, over a longer term period, you'll stop making mistakes. Like Devina says, you stop making mistakes and let the winners run. And that's how we do it. So my sweet spot is anywhere between 20 and 30 stocks. That's a lot. That's 50% more, but that's a sweet spot that we are in. Okay, so that's a little bit of the concentration paradigm that I've come across.
Okay. Ridham, I want to ask you about, there's a final session this evening about how to generate alpha. But since you're not going to be there for that section, I want to touch upon what Saurabh said earlier about ETF investing. Because the strange phenomenon is that India did very well relative to other markets in 2022. But 60% of the funds in India actually could not beat the index. You know, all the PMSs and mutual funds did far worse than the index. How do you, we know why it happened, but what's the way around that?
So, Udyan, that's not a 2022 problem.
Perennial problem.
That's a perennial problem. I think Devina mentioned this, that picking a 10-bagger or a 100-bagger, knowing that in advance is very hard and almost impossible. Likewise, picking a fund manager who's going to outperform in advance is a similar exercise, and it's not really possible. And I think it was in the 1994 Berkshire Hathaway AGM that Charlie Munger, in response to a question about how to invest, said that unless you have Warren Buffett's skills, just buy index, right? And the index investing has boomed in America as a consequence of the fact that it is very hard to know in advance which fund manager will do well. And this actually goes back to this whole concentration and diversification debate. It is all right to concentrate so far as you have the skills and, more importantly, the stomach to sit through it. I mean, what Saurabh has, which a lot of us don't have, is a lot of stomach. I mean, he can sit through that volatility that a 15-stock or a 10-stock portfolio will suffer. If you don't have that stomach, and if you're prone to making mistakes, when your stomach starts grumbling and you start feeling uneasy, then you have to do what Devina is saying, which is buy a well-diversified, geographically, sectorally, asset-wise, which will not go through those drawdowns that, concentrated portfolios go through. So I think that's where the concentration versus diversification debate lies. There is nothing right or wrong. It's just about your own, what is your own character? What is your own character? Do you have the ability to sit through the extreme volatility that concentrated portfolios tend to suffer from? So going back to your question, it is as difficult picking up the winning fund manager. So if you don't have the stomach to go through that underperformance, then you have to do what Devina says. And if you can go through it, then, fund managers bounce back, just like markets bounce back, just like stocks bounce back. So those who underperformed in the last 2 years will likely outperform in the next 2 years. Only thing is we don't know who. And on the question on ETF, I think Saurabh alluded to it. It's a pretty scary thing out there, because I think now 40% of global equity assets are sitting in ETFs, and they will produce anomalies on valuations and prices, which will be, of course, mouth-watering for active fund managers. But while that process is on, it's not going to be a very easy process to deal with. And one of the reasons why active fund managers suffered in 2022 was as a consequence of this phenomena. It's starting to happen in India. It's building momentum. ETF is gaining size. In fact, it's gained, I think if I'm not mistaken, it's up 25 times in the last 5 years.
Wow. Saurabh, what is this fair amount of stomach that your investors or any investor should have? Because it is normal for fund managers to go through years where they will underperform. And it's normal for fund managers to say, in the long term, I will make good. But as a fund manager, what should you tell your investor that give me these number of years, and if I'm still underperforming, then something is wrong?
So I think that the stomach piece is exactly the heart of this, right? So just to sort of take the first inference from the stomach piece, because this is tough, because running concentrated portfolios even in America is tough, you don't have too many Warren Buffetts or Rowan Cunniffs or Lou Simpsons and so on, right? The concentrated investors, even in a giant market like America, are few and far between. And as everybody on this panel is saying, America is getting ETF'd. And as America gets ETF'd, the inefficiencies are greater, right? There are fewer and fewer active investors applying their mind, that means the opportunities for concentrated portfolios are greater. But as everybody is saying, you need stomach to do this. Now, let's understand what do we mean by stomach. What we mean by stomach is as follows. If, for example, if everybody in this room has seen that for 30 years Pidilite has made white glue, and white glue has sold, and Pidilite, I think, has compounded free cash flows at 25-27% for the last 20 years. Naturally, everybody in this room will infer that Pidilite will continue compounding cash flows, say at least for the next 10 years, right? So Pidilite becomes like a long government bond, 10-year government bond. The expectation from most people in this room will be, Pidilite's done this for 30 years, they'll do this for the next 10, and let's therefore treat it like a 10-year government bond, steady cash flows for at least 10 more years. In contrast, if Coal India hasn't grown free cash flows, or actually hasn't had free cash flows many years, and those free cash flows don't grow, nobody expects Coal India to be growing cash flows for 10 years. Perhaps people expect it to grow cash flows for 2 years. It becomes like a 1-year, 2-year government bond. Now, in that circumstance, if you bang up US interest rates by 4%, naturally the company which has got greater growth embedded in it will correct more than the company that has less growth embedded in it. Coal India or a Power Grid had less growth embedded in it, it will correct less. If you have, like we do, a concentrated portfolio, it will fall more than a portfolio made up of, as everybody here is saying, a mixture of things. If I had Power Grid, Coal India, public sector banks, it would fall far less because the embedded cash flow growth will be, the expectations will be far less. Now that we infer is an opportunity. Effectively, if you see our portfolios, profits are up 20-25%, EBITDA or cash flows are up 20-25%, but the share prices are down 20%. As everybody is saying, that's a challenge for the stomach, right? So I've had to have lots of ENO or digestives to deal with the fact that my profits are up, EBITDA is up 25%, share price is down 20%. And all we have to do then, in inverted commas, all we have to do is tell our clients, what do you want to do? Do you want to follow share prices through the rest of your life? Or do you want to follow companies whose profits are rising 20-25%? In fact, in our small cap portfolio, EBITDA is up 35% first 6 months of the year, although share prices are down 15%. What do you want to do? Do you want to invest in companies whose EBITDA is up 35, share price down 15? Or do you want to follow Coal India, Power Grid, State Bank of India, which is a perfectly valid way to invest? That's a perfectly valid way to invest. Our point of view to our clients is follow the companies who compound cash flows consistently. Yes, you will have rough years, like the last 12 months, but that's the nature of the beast. If you didn't have those rough years, then everybody would do what we do now, right? And therefore, that is the balance, the perpetual debate in investing. Do you want a basket which has got everything in it, Coal India, Power Grid, State Bank of India, Bank of Baroda, and Pidilite, Titan, or do you just want the quality stuff? If you just have the quality stuff, you will go through rough periods. In Hagstrom's book and in my practical experience, out of 3 years, you'll have one rough year, right? Typically, sometimes you have longer, but typically out of 3 years, you'll have one rough year. But that's the price you pay for superior performance in the long run. If we look at America as a whole, and if we say the Indian market will one day end up like America, the American public is saying we have no appetite for trouble. We want the whole stock market in our portfolio, hence the rise of ETFs in America. And perhaps if we end up like that, then people like me will have greater anomalies that I can profit from. But yes, as Ridham and Udayan are saying, we will have a bumpy ride along the way.
You can hardly blame the Americans for not wanting trouble. They had Trump for 4 years.
It's a valid point.
Kenneth, the other thing which keeps coming up in conversations this time, I'm sure it comes up in conversations with fund managers like you, is you had a year where most funds delivered low single-digit returns. Fixed deposits are giving you 7-8%. Fixed income is looking quite attractive as we enter this year. Can you promise returns superior than fixed income in the foreseeable future?
Well, that's going to be one of the biggest challenges for equity, right? And I don't know about 1 year, but over a longer term period, that number is certainly quite okay. Delivering over a high yield over fixed income, that's certainly okay. Because if you look at most of the established portfolio managers who've got more than a 10-year track record and are still around in some format, they have done in excess of 13 to 15% of CAGRs through that entire period. Near term, that challenge exists. I think it's a great time for investors. So apart from just saying that equity is the only thing that you need to invest in, though I'm an equity manager, I think fixed income gives you an enormous opportunity.
Please.
The debate is actually not about fixed income. In the last 5 years, 4 out of those 5 years, the top performing asset class for an Indian investor has been gold.
Gold, I know. But gold is such a bad word for people like you, I dare not mention it.
No. That is one that begs attention, because if you look at it from a long-term perspective, again, going back 25 years, yes, the Sensex has been the best performing asset with a lot of volatility. Gold has come with lesser volatility, but it doesn't fare so poorly. No. Fixed income, which is fixed deposits and the treasury, and surprisingly even property, has done very poorly compared to gold and equities. So I think the debate is this, another year for gold.
Devina?
I'd just like to add to that. The gold, if you look at from about 83, 84, for 20 years gave zero return. So nothing is, as I said, no bit, which is that have that for a limited period of time, just as every other country in history has had. But we have not been able to find employment, even pre-COVID. Even pre-COVID, our unemployment rate was at a 40-year high. Unemployment is even higher among the young. So that is what worries me, that you will never get that demographic dividend actually show up in the economy, because you're not able to employ those people. And that employment drives things at both levels. One is at the output side, manufacturing or services, as well as then therefore that per salaried person consumes stuff and therefore drives demand for everything else. So that to me is that we'll miss that bus. That to me is the biggest worry. And which also ties into education, health, especially after the pandemic when children have lost 2 years of schooling. Because if you don't invest in education and health, you'll have a next lot of unemployable people. So for, whether for the budget or longer term policy, those have to be the focus areas: employment, education, health.
On that note, thank you very much, all of you, for joining in today. Thank you very much indeed.
Thank you, Udayan, and thank you, everybody. Well, no summit would be complete without a discussion on the macros and the fiscal picture. So let's talk about Budget 23-24. Joining us is an esteemed panel of economists to really give us some insight and expectations as to what's in store for us this year. In conversation with Rahul Kanwal, News Director, India Today Television and Aaj Tak, Executive Director, Business Today, I'd like to invite on stage Pranjul Bhandari, Chief Economist, India, HSBC, Samiran Chakraborty, Chief Economist, India, Citibank, and Soumya Kanti Ghosh, Group Chief Economic Advisor, State Bank of India. A big round of applause, everybody. Thank you so much for joining us. Rahul? I think you've scared him into... Yeah, he's... There he is. Rahul? Yes, great. Over to you for this wonderful conversation on the fiscal overhang and with an eye on the budget.
Hello and welcome. The last session at the World Economic Forum in Davos is a global economic outlook. And what I thought we'd do over the next several minutes here at the Business Today Market Summit is to do an India economic outlook with some very sharp economic minds. And the global consensus seems to be that the world could potentially be able to avoid a hard landing in a deep recession and instead get away with a softer landing and slowing growth. What does that mean in the context of the India growth story? We have a big budget coming up in just a few days from now. Crucial also because this is arguably the last budget before the election cycle kicks in. So what can Finance Minister Nirmala Sitharaman and the Modi government do to capitalize on the unique global headwinds and tailwinds that are playing out at this moment? So to talk about this at the Business Today Market Today Summit, I want to introduce our panel of guests, starting with Pranjul Bhandari, Chief Economist, India at HSBC. Flanking her, Samiran Chakraborty, Chief Economist, India at Citibank, and Soumya Kanti Ghosh, Group Chief Economic Advisor at the State Bank of India. So let me start by asking Pranjul about what do you think Finance Minister Sitharaman can do at this moment to try and make most of the global tailwinds that seem to be blowing in India's favor?
Yeah, thank you very much. I think the best thing that can be done now is to keep the budget boring. And by boring, I mean keep it predictable, keep it credible, and just go on the path which you've promised. Now, we talk a lot about growth, but in a year like 2023, when there's a lot of uncertainty globally, I think the best thing that we can do in India is maintain macro stability. And macro stability means low inflation, fiscal consolidation, lower trade deficit than what we had last year. Because if the stage is set with macro stability, when the global economy turns and rises again in the next couple of quarters, hopefully, India will be ready for a takeoff. So I think the budget should be boring. It should basically focus more on macro stability rather than high growth. And from that perspective, I think the path is very clear. The finance minister has already spoken about a fiscal consolidation path, bringing down the fiscal deficit from 6.5% to 4.5% over the next 3 years. It should really, focus on that path. Of course, on the background, some changes can happen. For instance, improving the tax regime, and we can come back to that later, and also focusing on capex, which has been a thrust of the government, but mostly focusing on continuity rather than doing something dramatic and big bang.
Given the emphasis that we've seen on public spending and capital expenditure, do you see that continuing, or do you think it's reached a level where the government will need to start cutting back, Samiran, to some extent? What do you think can be done in this unique moment for India to try and step on the accelerator on economic growth?
Clearly, Rahul, I would say that investment. I think in the last year's budget, if you look at, this was the theme of the budget. We don't change themes every year. So there is a need to continue with that theme. And our sense is that not only in rupees trillion terms, but also as a percentage of GDP, there is a need to increase the public capex part. And increasingly what the central government is realizing is that it's only a limited areas where the central government can make a lot of capex. The power lies often with the state governments. So it's quite keen to deliver a larger amount of resources to the state governments to spend as well.
But when I speak to bureaucrats and ministers in the government, what I find is a growing sense of unstated frustration with the fact that when it comes to spending, the government is having to do the heavy lifting, and despite the deep and sharp reduction in corporate taxes, private investment isn't stepping up to the plate. And I think Nirmala Sitharaman has publicly spoken up about this a couple of times, nudging India Inc. to do more when it comes to investment. But that, for some reason, doesn't seem to be happening.
So I don't think there is any other option but to be patient. We have to understand that even pre-pandemic, India was going through pretty slow growth compared to what India's history has been. And the pandemic has obviously had almost 2 years of low growth. And now with this whole geopolitical uncertainties, it's difficult for private capex to immediately pick up, given the background that we have seen of last 5-6 years. But what we have to also keep in mind is that we are now reaching almost all the preconditions that are required for a private capex recovery. Look at corporate balance sheets. If you look at the financial system balance sheets, we haven't seen this kind of a balance sheet in almost a decade. So with the right kind of public capex and the policy thrust that is there towards manufacturing that this government has put forward, I think it's just a matter of time we will see a private capex recovery.
But Soumya Kanti Ghosh, this is something that the pundits have been saying for a long time, that capacity utilization is in the mid-70s. India is poised for a multi-year investment cycle, an investment cycle which so far hasn't kicked off in right earnest. Why? And do you think, like Samiran, that that's now finally about to change?
Yeah, thank you, Rahul. No, I think that last 2 years during the pandemic, if you look into the corporate balance sheet, they have significantly deleveraged. And so that's the first thing. So that's one of the preconditions for investment taking off. The second point to note is that if you actually look into the bank credit today, credit growth actually has continued to expand, even though there has been some moderation in the recent weeks. And a large part of this credit growth is not only the working capital requirement, which typically comes when the inflation is on the higher side, but also term loans and also some project announcements, as we are seeing in our books. So in my sense, I think there is evidence of an pickup in private investment activity. May not be that encompassing which all of us want it to happen. But at this point of time, if I look into the sectors which has deleveraged, like steel, like the metal sector, there is evidence of some amount of private investment picking up. But as we progress, and as basically as all of you also, as also there has been a lot of geopolitical conflict and uncertainty. So I think as the fog clears on the global economy also, I am sure that the investment is going to take off in a meaningful manner.
One of the Modi government's big thrust areas is to boost manufacturing and to take manufacturing to 25% of India's GDP. The needle hasn't moved much when it comes to the ratio of manufacturing as a percentage of GDP. In Vietnam, it has. And the big question in India and globally is, to what extent is India being able to benefit from a global realignment of supply chains, with many global corporations looking at an India plus one strategy? Is, Pranjul, in your view, India likely to be the prime beneficiary or just one of the multiple beneficiaries of this realignment?
Yeah, I think the good news is that India has gained global market share in some high-tech sectors like mobile phones, drugs and pharma, automobile parts, and IT services. So that's the good news. But the problem is that we are actually losing global market share in trade in medium tech and low tech. For example, textiles, for example, small electronics, for example, agricultural products. I think our problem is why our manufacturing to GDP share is not rising dramatically, like, for example, Vietnam that you mentioned, is our industrial structure. We have too small firms which never grow over time. We call it the economic dwarfs. There can be different names to it. The problem is, if there are too small firms, they never gain economies of scale. They never become too efficient to sort of, really compete on a global level. And that is, I think, our real problem. And I think the big challenge is, how do you let small firms grow from small to medium to large, which is something in our country we don't see too much of.
I had a fascinating conversation with Raghuram Rajan, Pranjul, at the World Economic Forum about manufacturing and electronics. And his argument, and I'm curious to know what you think, is that PLIs is basically subsidy for capitalists, that there is very little value add happening. And while, of course, manufacturing is growing up, there's nothing to tom-tom about in terms of it being a big achievement for the government, that this is money that could be more wisely spent in things like higher education, produce more engineers. That has a higher ROI than just giving money through subsidies to corporates.
My sense is the PLI scheme is an experiment worth doing. We are trying to sort of, look into futuristic sectors and ensure that, India at least tries, right? And the other reason why I think we should do it is because it's actually not very costly. Barring the semiconductors, it's just over 2 trillion rupees spread over 5 to 6 years, which is our 1-year fertilizer subsidy bill. So it's not that much money. And even within that, the money was made possible by retiring some old export subsidy schemes. So there was like smart thinking done there, and I think this is an experiment worth doing. But is this enough? Will this change India's future? Will it make it a big manufacturing hub? I don't think. I think a lot more needs to be done. Most importantly, I think overall business climate needs to improve in a way that small firms can grow and become large over time.
Samiran, especially on the issue of value add, opinion seems very divided amongst pundits on the efficacy of production-linked incentives. Are they working in your view, or are they not working in the way they should?
So Rahul, in a very broad sense, economists will always argue against subsidies in any context, whether it is a context of in manufacturing or it is a context of food subsidy. Economists have a natural bias against subsidies. But having said that, the way to think about PLI, in my view, is that is it going to be enough to move companies who were thinking about investing in other geographies to come to India? Is that going to give that extra bit of leverage to us? And in that context, it's very important that the first few PLI schemes are success. Because I can tell you from my experience that a lot of foreign companies are thinking about India, but they are also fighting a perception battle that in the past, investing in India has been difficult. So if there are some companies which can show that, yes, India has changed and it's possible to do business in India and be profitable, then a lot of players who are waiting in the wings can also join into the scheme. While Pranjul is making a very valid point that the extent of subsidy is still very limited. It's less than 1% of GDP by our current GDP standards. The critical thing is that the sectors on which PLI is there is also less than 1% of GDP. So even if that less than 1% of GDP grows at a very fast pace, that's not going to move the overall GDP growth needle. So either we have to think of this as an experiment which brings in more investment in other non-PLI sectors, or we will have to expand PLI to a vast many sectors for us to see the whole macro impact of PLI. Otherwise, what's going to happen is that this year we will be discussing PLI. Next year when you are going to call me, you are going to find another acronym and we will keep on discussing that acronym without having the continuity that we require.
Now, Soumya Kanti Ghosh, you're very bullish on some of the policy moves that the Modi government has made and their potential impact on Indian economic growth. But like we were hearing in the conversation with market experts before this, the fact that this is India's moment is not being said for the first time. Now, this is something that's been said multiple times in multiple years gone by. And therefore, what makes you confident that this is truly India's moment? Because in the past, we've had the knack of finding some way of snatching defeat from the jaws of victory, or not being able to capitalize on the moment like we should.
Yeah, thank you, Rahul. I think I'll just very quickly quote some data points to support the point that Indian economy is actually placed in a sweet spot. The first is that look into the banking sectors. The net NPA is now at 10-year low. Credit growth is at 10-year high. Look into the digitization. The total number of UPI transactions this year is already touching 100 trillion. That could actually go up to 130 to 35 trillion at this rate, which could be 45% of India's GDP in the current year. Look into the SME sector. The overall credit growth in the current year, 10% is being contributed by the SME sector, and there is now clear evidence that a part of the SME sector is actually getting bigger. That means they are moving up the value chain. Then there is the look into the external sector, export data. Even if last year we did 420 billion, at the current rate we could actually do around 450 billion. This is apart from the services data. Tax to GDP ratio this year could be at the highest level, and India is the only country which has increased and seen an improvement in the tax GDP ratio. So there is compelling evidence of the data supporting that we are in a sweet spot. But the fact is that we need to take advantage of that. In the past also we had done, even in the external sector, we have already recouped more than 50% of the foreign exchange reserves, which was at the lowest level at the end of October. So in rupee, in real terms, it is actually appreciated if you look into the BSI data. So household debt to GDP ratio, look into the latest BSI data, it has actually now declined from the peak in March 2022. So on all counts, we are in a sweet spot. The point is, where do we grow from here?
Okay, so let's come to that, because we saw recently the World Bank enhance India's growth forecast from 6.8% to 7% for this fiscal. I'll start by asking Pranjul first for her broad sense for how the Indian economy is likely to grow next year.
Yeah, I think next year is going to be a bit turbulent and growth is going to slow down for a couple of reasons. One is global trade is slowing. You mentioned that a lot of people are not expecting a hard landing, but it's still slowing across the world. We can see trade volumes that we track very easily slowing. So exports will slow, and exports are important because they were a big driver of our growth when we bounced back from the pandemic. Then if you look at our consumers, a lot of the pent-up demand after the pandemic is now done. If you look at the deposits at bank, they are back to pre-pandemic levels. And then you have a government which is trying to bring down the fiscal deficit. Fiscal consolidation in the short run can take away from growth. So I think for all of these reasons, we will see growth softening in 2023. But we should not worry about it. We should focus about macro stability, keeping inflation low, bringing down fiscal deficit. Because once the global cycle turns, I think India today is really geared for a takeoff. And I would agree with Soumya Kanti Ghosh on many of these points he's made. I think there are two very exciting sectors: high-skill exports, where India is doing well, and then the entire tech startups. I know it's slowing a little bit right now, but this consolidation is good. I think in the medium term, our tech startups can find a lot of digital answers to real-world economy
problems. At this moment, what's your estimate for growth for next year?
For next year, we have growth at about 5.5%. But after that, we have growth going back to 6% plus.
At this moment, you have no intention of revising upwards the growth figures from what you did previously.
Yeah,
okay, Samiran, how do you see India's growth outlook for next year?
As Pranjul was mentioning, that there are some headwinds to deal with, but the way I generally want to look at this number is that if you look at last 2 decades, on an average, consumption has always contributed about 400 basis points to GDP growth, at about 4%, becomes like a absolute bottom for us. And on top of it, if we get just about 7% investment growth, we are at 6% overall GDP growth. So I think 6% kind of becomes a number which is quite achievable. On top of it...
So you're slightly more bullish than Pranjul is?
Yes, I am. I think that the current data is not supporting a slowing economy. So there is right now a big disconnect between the data and the narrative. The narrative is more negative, as some of the things that got discussed earlier about headwinds coming from global slowdown, headwinds coming from fiscal contraction, monetary tightening. But you look across all high-frequency data, there is barely any slowdown in that. We are still running at a rate which is almost pre-COVID growth. So I think I will be slightly more optimistic on achieving a growth number of closer to 6 next year. But obviously global headwinds can change.
So we are getting more optimistic as we go from right to left, from 5.5 to 6. Soumya Kanti Ghosh, are you taking the needle up even further?
No, I think I would tend to agree with Samiran's point. We are a little higher than 6%. I think one possible advantage next year is that prices will actually be rapidly cooling off. So, for example, oil prices. Also, the fact is that globally, domestically, I think inflation possibly has seen the peak, and inflation will progressively come down next year. Food prices has been surprising, even after such an bad weather in the last 3 months, I think unseasonal rains, food prices have behaved remarkably well. And with a 46% weightage in the overall CPI basket, if inflation behaves well, which is doing right now, and actually it has surprised a lot of the market expectations and forecasts, I think the stage could be set for a positive GDP surprise next year, because all GDP numbers last year, I think there is a disconnect between the leading indicators and the GDP. Last quarter GDP, the forecast which the NSO gives out 7%, I think that was nobody was expecting. So I think that next year we could see a positive surprise on a back of a relatively stable macro environment where inflation will not be an evil as we have seen this year.
Now, one of the reasons why so many global companies are bullish on India at this moment is also because what's happening in China. But on China, opinion is divided. Pranjul, the one sense is that China's decline in terms of economic growth is now permanent. There, the number of old people is growing up, the youthful population, working age population coming down, and therefore this idea that companies will look beyond China on the back of the pandemic, on the back of growing trade tensions between China and the United States is now inevitably going to help India. The other thing, the other thought is that some of the obituaries about China's growth have been written in the past wrongly so, and China is a story which global leaders like to kick down. Look at the manner in which the economy is reopened after all the COVID cases and the deaths stabilize, and because Xi Jinping seems to be showing greater moderation and more pragmatism, China may not be as badly written off as many pundits would like to believe. Where do you see China go next?
Well, look, I just want to make one point here. What we find in China right now is that they are sitting on about $1 trillion of excess savings of households who were in lockdown for 3 years. And as they gear to spend, that will provide some stabilization to global growth. When you made the point that we will not have the hard landing, I think a lot of that will come because now China is reopening and Chinese households and consumers are ready to spend, are ready to travel. So from that perspective, you can't completely write off, a very large economy like China. There are global value chains that are rejigging across the world for various reasons. A lot of people talk about deglobalization in growth and maybe there are in goods and maybe there are not too many opportunities there. But I think where India has a big opportunity in front of it is a continuing globalization in services. I think, we stand in a very unique position. We've been there from the knowledge processing center days to now the GCC, Global Capability Center days, when a lot of large multinationals want to put a lot of their research and back-end work in places like India. And I think we really stand to gain on that part of the global rejigging of supply chains.
Samiran, now two things could happen in China. One, because of pent-up demand on account of the economy and the country being shut for 3 years, China is bouncing back, but this is temporary. It kind of falls to a new level, which becomes the new normal for China. The other is that don't get pessimistic on China just yet because it could bounce back and stay high. What do you think will happen next?
So Rahul, very interestingly, if you look at the IMF forecast for India and China growth, what strikes is that over the next 5 years, India's GDP growth is going to exceed Chinese growth. And that's going to happen first time after 1960s. For 1970s, 80s, 90s, 2010, 2020, 50 years, India's growth has always been lower than China. I think that way, it's a unique opportunity for India. But if I answer your question more directly, there are two things going on in China. One is the reopening trade. The other is the real estate trade. And both things can have very different implications for India. I think the reopening trade, the $1 trillion excess savings that Pranjul was referring to, is going to be spent more on services. That's not going to cause much challenge for India. It's the real estate trade. If the Chinese real estate now starts picking up, that's going to create the next commodity price cycle. And that can destabilize the point that Shoma was mentioning about low inflation in India for 2023 being a tailwind for us, that theory can get questioned. And the last issue is that to what extent this China reopening would lead to a reallocation of capital flows in the EM space. We are already seeing that in the first few days of the year, money has flown or got reallocated from India to China. The Chinese market valuations are much more attractive at this moment than the Indian valuations. So if this continues, then that can become some sort of a headwind. So commodity price effect and the capital flow effect are the two things that I will have to watch out for.
Soumya Kanti Ghosh, a lot of the current economic narrative around China was built at a time when the economy was shut. Xi Jinping acting as the ultimate emperor, taking impractical, irrational decisions that seemed to be damaging the economy. The last few weeks, though, at great cost to Chinese health infrastructure, has suggested much greater pragmatism. Does that then mean that a lot of the benefit that a country like India would have been hoping to get out of China's economic slowdown now just stays hawa mein and doesn't actually materialize on the ground?
I think that's an interesting point. But before that, let me just give you one data which Samiran talked. I think in terms of the stock market resilience, India's the market capitalization is increased in dollar terms 2.3 times than what it was in March 2020. So that's one of the impact of this China. Now, specifically in terms of China, I just want to play a devil's advocate over here. I think China is always difficult to believe the data. So, yesterday there were some numbers which were saying that 80% or 90% of the population is already going to get infected. And please note that China doesn't have an effective vaccination strategy for its population, which India actually had, and India was able to quickly ramp up the vaccination for its population and in a war mode. So with the country and given the type of disease it is, the COVID, I think without an effective vaccination strategy, China may be reopening, China may actually, there could be some reallocation of capital. But over a point of time, I think India will stand at a far better advantage because after
once
this
China reopens, and let's assume that 80% of the population has been infected, whoever is vulnerable and susceptible suffers the consequences. A lot of people even die. But then the economy is open and people have immunity. So they can get back to business as earlier.
Yes, but that will take time. For India also, we saw that vaccination strategy played out over a point of time. From May 2020, when they started to vaccinate the people, we were able to vaccinate a large part of the population in 2022 beginning. So if I go by that trend only, with the same population of China and India at this point of time, I think it will take a larger time to vaccinate this entire population. Till that point of time, we can enjoy the tailwinds of the global economy. But of course, as China opens up gradually towards the end of the year, it could be competition between the two.
In the few minutes that I have left, I want to spend time talking about the outlook for GST collections. We've seen GST collections on a monthly basis hover in the range of about 1.5 lakh crore rupees. Is that, Pranjul, where you see GST collections stay next year? Do you see a potential for a moderate to high increase, or do you actually see them come down on a monthly average basis?
Well, it should rise in line with nominal GDP growth. But if you want it to rise even more sharply, like we saw over the last year, I think we need continued reforms in GST. We need to get more items into the GST umbrella. We need to talk about lesser number of slabs, more uniform rates. I think we need more reforms on GST if we want continued improvement.
Which of course every economist and right-thinking person would want. But Samiran, are you concerned that given the practical reality of this being a general election year, that any reform, whether it is on the GST side, whether it is on tax, or whether it is in terms of pushing through hard disinvestment, will actually now only be seriously considered after the 2024 general elections? Or do you think that the government could potentially surprise?
So just a quick point on GST is that this is a peculiar year where for the first time, the central government will be collecting 1.4 lakh crores of GST compensation cess, but will not have to share it with the state governments. So that's going to make the fiscal arithmetic look much easier for the central government. But on the reforms question, I think where I started from is where I want to end with. public capex is one area which I call reforms, which will have no political ramifications. So it's the easiest one to push even in a pre-election year. If you look at other reforms that economists typically talk about, there are winners and losers in those reforms. And typically every finance minister will be very considerate about implementing those reforms in a pre-election year. So I'm not penciling in too many of those reforms for this year, but public capex push is something which everyone likes, affects everyone positively, so why not do it?
Soumya Kanti Ghosh, are you surprised with the government's approach on disinvestment? Arguably the most vexatious PSU to disinvest was Air India, which got pushed through with a lot of determination, and a lot of other strategic disinvestments, which should arguably have been easier to find a way to push through, have somehow not been done. And are you fearful that given the fact that we have an election, that a lot of this could be pushed out till after the next general elections?
Yeah, I think the answer is both yes and no. In terms of the disinvestment, I believe that more could have been done. But on
this is what economists love to do. They like to give answers which have both yes and no, and everybody else, like normal citizens, wondering, did he mean the yes more than, or did he mean the no more?
I'll explain that. But the good thing is that the government has been able to compensate the decline in disinvestment revenue through a surge in the tax collections. The tax buoyancy ratio, which is historically at 1.1, means that it has been much higher in the last 3 years. So whatever has been the shortfall in the non-tax revenue has been compensated by the tax revenue, and that is because of the efforts which the government has been doing. So in my sense, yes, there could be a shortfall in disinvestment, or may not be that to the extent which we could anticipate. But my sense is that a large part of that will be offset by a buoyancy in the tax revenue.
Now you have to explain the yes and no on disinvestment. It can either be a yes, that they will push through on disinvestment despite it being a general election year, or it can be a no, they're more likely to push it out till after the next elections and not take any panga at this moment.
I think in terms of the disinvestment, some of this is very politically sensitive. Also in terms of the privatization, I think maybe that may not be touched this year. Maybe that could be pushed next year. But there is always this helping hand in terms of the tax buoyancy.
This was an interesting conversation. I want to thank Pranjul, Samiran and Soumya Kanti Ghosh for joining us at the Business Today Market Today Summit and sharing your thoughts on India's economic outlook. Thank you so much. Thank you.
Thank you so much, Rahul, and thank you to all of our guests. Now, I don't know how many of you invested in some of those tech stocks, the tech darlings of Wall Street while things were good. But we're here to discuss what to do with them when things are not going so good. Investing beyond Indian horizons. In conversation with me this evening, I have joining me take a moment to make sure we're ready. Yeah. I'd like to welcome on stage Neil Parag Parekh, Chairman and CEO, PPFAS AMC, and Prateek Oswal, Head Passive Funds at Motilal Oswal AMC. Gentlemen, thanks so much for joining me. All right, great. So, where should we start? Because things are taking a nosedive, and I think the best place to start is exactly there, and understand how you're viewing the current situation when it comes to the tech winter that we're seeing on Wall Street. Is this just the beginning? I mean, people have lost a substantial amount of money. Did you see this coming? According to Rajiv earlier on, didn't see it coming fast enough.
Hi, thank you, Abba, to have me here. First of all, I think when we're talking about the tech sector or the NASDAQ in the US, I think we need to differentiate between mature tech companies and the new age tech companies, So I think during COVID, we've seen a lot of these companies go up. multifold, obviously because interest rates were low, funding was easy. So a lot of these companies went up without any fundamentals, So I think that is one space that I am not that confident that it could bounce back or there's some pain left there. But on the other side, there's the mature tech, which is your Googles, Facebooks, Microsoft, Amazons, the bigger companies, which you can, they do have fundamentals, they are profitable, they are growing well. And if you've seen over the last 20 years, 20-30% fall in tech stocks is not that uncommon. So we are not perturbed about the mature tech space. In fact, they provide a good entry point right now. So I would differentiate between the two. I'm not too confident about the new age tech, but I'm very confident about the mature tech.
All right, Prateek, what do you say?
Yeah. Firstly, thanks, PT, for having me out here. In terms of I think tech stocks or investing in US or outside of India, I think just to take a step back, a little bit, I used to be a wealth manager in the US in San Francisco in 2018, and I had about 800 to 900 customers. All of them were 25 plus million in assets, so all ultra HNI types. And when I saw their portfolios, approximately 15 to 20% of their portfolios were invested outside their home country, which is outside the US. And I saw a similar trend of portfolios in the UK, in Europe, and also in Southeast Asia. And when I came back to India in 2018, I saw that no one was really investing outside. So I think it's important, yes. And one of the key differences to why I think investing international has worked well in the last, say, 5 to 10 years' time is because of, ideally diversification. What essentially investors gain by sort of, having some of their portfolio outside their home country is that what we've seen is markets in the US and markets in India or international markets versus Indian markets move in very different directions. And that provides a lot of flexibility and a lot of diversification in your portfolio. What we've also seen is that international diversification is the only such asset class that actually not only sort of gives you the same returns as what you would have in India, but also really leads to a much better sort of portfolio in terms of diversification, which is what we saw last year as well. The fact that Indian markets were resilient and the US markets weren't shows that diversification just play out really well. And obviously the idea is to really ensure that some of your money is diversified, and that's essentially where I think investing in international comes in. When it comes to tech stocks, I sort of agree with Neil out here. I think if you compare, say, last year with, say, the crisis that happened in '99, where there was an entire tech rout, back then you had a lot of these companies who were growing fast, but their balance sheet and P&Ls were quite weak. If you see last year, or if you see the current status of tech, these guys are absolutely cash flowing machines. They make a lot of money. Their cash flows are very strong. I think what we've seen, which is a positive trend that happened last year, is that the expectations have come down, which is actually great because, all of these companies who were valued at trillions of dollars were still being expected to grow at 50-60% CAGR. So I think, now that we have some normalcy in the markets, and also their business models have not been impacted at all. In fact, they've become stronger since we've seen post-COVID. And I think, the entire tech revolution is still, yet to unfold. And it's going to obviously impact a lot more markets in the future than we have. So I do think that, obviously, investing internationally is great in terms of diversification. I do think that, most people would not really understand how to diversify, which is why I think mutual funds make a lot more sense for investors.
Okay, so fair point. I mean, you talk about diversifying into investing internationally, but of course, anything anyone thinks about is tech and Wall Street. So I want to get an understanding of, when you are investing, beyond the Indian horizon, what are investors asking for? I mean, are they literally just asking for FANG stocks, or are they also looking beyond? And secondly, when you say that expectations have moderated, have they really? Because we're looking at a 80% drop or a 50% drop coming in on some of these big names.
I think for the The return part of it, I think we've been spoiled. I think last few years, I think we all have been spoiled for good returns. I think the expectations are still high. I think we've not seen a bear market for a while, and the newer investors who've come, and a lot of them have come over in the last 4 or 5 years, they've not seen an elongated bear market, and that's what worries me. The worry is that the expectations are a bit high still, and I am not sure that, the last 2 years or before this year, the previous 2 or 3 years was great run, we got 30, 40% kind of returns, on a yearly basis, but that spoiled a lot of people. I think return moderation, it will happen. I think some people will learn it the hard way, that, getting 12, 13, 14% return is great actually from equities, I don't think you should expect anything. Sometimes now I see the younger lot at least just expect 20% return, but that's going to be tough to get. Some people will learn it the hard way. Some people will obviously, hopefully we all will educate them and make sure that, the return expectations are maintained, and that equity is a long-term product, we are obsessed with the last 6 months or the last 1 year returns, but we're big proponents, and all of us here in the mutual fund industry, we keep talking about long-term investing, equities, 5+ year investing. But in the end, everything is, we're judged by the last 6 months or the last 1 year, so that is unfortunate. That needs to change. But hopefully, some pain probably would be there. I don't think the next 1-2 years are going to be that great as what we saw in COVID. I think some normalization will come through, So I think, in fact, right now we're in a very normal market. I think that time was an abnormal market where negative interest rates or low interest rates, easy funding, markets just going up, anything and everything was going up. I think this year or the next 1 or 2 years will be a stock picker's market. You'll have to be really careful of what you pick.
I was just going to ask you that. I said, look, you have all the research, the reports, the analysis, the insight to tell us what makes a good investment when it comes to specific stocks, or even if you're going through a mutual fund, let's say you want to know where your money is going when it comes to some of these names. Where do you see value, or what is attractive to you on foreign shores, and why?
Yeah, so when it comes to, I think investing internationally, there's typically, I would say, 2 ways of why most people invest. One is obviously they want to invest. There is this sexy version of, buying the FANG stocks, Google, Facebook, Netflix, Amazon, which I think is fine if you're taking a very long-term bet on those business models. The second one, as I said, is more on the diversifying nature, where you're looking at, putting in portfolio allocation towards, some of these, at least stocks or mutual funds out there, which I think is also good if you're from a long-term perspective. And there you also have to, have that patience to sort of ride the tech wave or, ride ups and downs. Well, there's typically maybe 2 ways of investing. One is through LRS and the other one is through mutual funds. What we've seen in my experience is that, LRS is a lot more expensive. However, investors who are looking at choice, obviously we don't have a lot of choices here in the mutual fund industry, can look at that space really well. Again, costs have to be monitored, but someone who's looking for something very simple, who's looking for a, excellent portfolio manager, who's looking at, diversifying, can look at mutual funds, or if someone is looking for a simple index fund, they can also do that. So there are very simple ways of, going about, diversifying, your capital internationally. In terms of, spots of value, I believe that, there is a lot of value today, especially on the basis of what has happened over the last year. For example, someone was talking about China right now. China, I think, has a current P of about 9.5 right now, which is crazy low. Obviously, it comes with a lot of risk involved. You also have, other European countries, Russia, for example, has a P of 2, which is crazy low. So I think value is there, but I do think that, investors, especially looking at going abroad, should ideally stay away from, doing too much research, because what I've seen in my experience is that the understanding is very less. Today you'll have someone come to you and say that 97% of wealth creation opportunities are outside of India, you should go for it. I can also say that 99% of commercial real estate is outside of India. Will you go buy it? Probably not, right? So I think what's important is investing in something you understand, and which is why I think something simple is a lot more effective for wealth creation than going out there and trying to pick specific markets or pick specific geographies or specific stocks also.
So with the changing environment currently, the changing rate environment and the fact that everyone's predicting doom and gloom, overseas, which may or may not happen, do you feel that there is more of a case to continue to invest in the India story, or as you said earlier, would you suggest perhaps keeping your portfolio diversified, maybe 20-30%, is what Prateek was suggesting, to keep for overseas markets?
Yeah, I think we as Indians, we have a home country bias, which is that we are obviously very attached to our country and we think we know a lot about our country and we're comfortable investing in India. The reason you go abroad to invest is not to get more returns. I think it's to reduce the risk, as Pratik said that different markets move differently, and that's the beauty of diversification. You want two asset classes to go against each other. That's diversification. There's no point of diversification. Everything moves together, comes down together. So that reduces the portfolio risk. The other thing is, like we said, most of the opportunities, or more than 97-98% of the opportunities are outside India. So sometimes just looking at 3 or 4% of the world, and we have 3 or 4% of the world market cap. So a lot of the opportunities lie outside India. And thirdly, I would think that a lot of opportunities in the listed space are in the US or in foreign markets. Like, for example, there's no equivalent to a Google or a Amazon or something like that in India. We don't have any cloud computing kind of companies, which if you think that's going to be the future and that's the growth prospect, then you have to go outside India. So I don't think you should be searching for alpha abroad, but I think you definitely want to diversify outside India to reduce the risk of the portfolio.
Okay, fair enough. So, give us, you were talking about doing it through mutual funds earlier, Prateek. So give us the best way to go about this, the kind of return expectation, your strategy now for 23, since we've entered a new year. Just give us a holistic view.
Sure. Yeah, I think in terms of, I think in terms of return expectations, that's super important. In fact, small story, in 2021, we'd actually, so we done one of the largest international funds in India that's investing directly in the US, and we actually, sent out 2 or 3 emailers to our clients saying that, you should, lower your expectations when it comes to international investing. There's a lot of, talk and all about it. And on the basis of those emails, the interest in international funds actually went up, not down. So I think it's extremely important for investors to have very lenient expectations. If you look at the last 10 years, you can see great numbers. For example, when you look at 10 years ago, the Nasdaq would have done, I don't know, maybe 20-25% CAGR. But over the last 20 years, it would have done roughly the same as what India has done. So I think in terms of return expectations, it makes sense to have the same return expectations as what you would have in India. But I think what's important is, investors should expect risk to come down dramatically because of, diversification to come in play. So I think that's what we essentially tell investors is, I think maintain your expectations and obviously have a long-term approach. The second thing, and this is what, I was, talking to Neil about, before coming here, is that there's 2 problems, at least, not when it comes to international investing, but investing in general. And that was really that sort of came into the picture in 2022, is that investors have, 2 things that are, sort of not going right for them. One is there's not a lot of sensitivity to pain is a lot less in sort of today's investor profiles than what it used to be, say, 5-10 years ago. So I think whenever an investor sees some, different portfolio not doing well or whatever, they tend to react very quickly. And I think if you ask any investor, successful investor, or even any entrepreneur, sensitivity to pain is extremely important, not only in success in work, but also success in investing. The second thing, and this is again something which has led to a lot more speculation, is investing in a lot of these. I wouldn't say fads, but something keeps happening every year. So you had the US investing, you had, cryptocurrency, you had sector investing. What happens is a lot of investors, tend to overvalue, owning something which is extremely exotic, because it's a lot more interesting. But actually, wealth creation happens in very simple products. I think an investor should ideally, have most of their portfolios in simple products. And obviously, if they are looking at something complex or something which is exciting, that should be a relatively smaller part of their portfolio. And the same with international funds. I think what I've seen is investors who go chase after these, electric vehicle or biotechnology or these sort of thematic funds. It's very exciting to invest in these sort of themes, but actually, wealth is made if you invest in something as simple as an S&P 500 fund or like a simple broad-based mutual fund. And just sort of sticking to, I think consistency is very, very important for investors. And investing in general, I think, remain invested. If you have a thesis of you wanting to, put in 15 to 20% of your portfolio outside, stick to that thesis and, make sure it's there for the portfolio.
Neil? If you want to add to that in terms of, what you're looking at in 2023, in terms of overall strategy, with regards to all the moving forces when it comes to global markets right now.
Okay, so let me try to answer this slightly differently, So a couple of years back or during COVID, somebody asked Jeff Bezos of Amazon that so much is changing. How are you looking at things and how are you looking at change, And he had something very interesting to say. He's like, I am not really focused on what is going to change. I am more focused on what is not going to change. So let's see for Amazon. So he said that for Amazon, what is not going to change? Even 150 years, 100 years from now, what will not change? One is that when people are searching on Amazon, they are looking for the lowest cost product, So my job is to keep making the cost lower and lower. It's not like we go to Amazon and look for the highest, the most expensive product, So cost has to come down. Secondly, people want more and more choices. So his thing is that people are 50 years from now also going to want more and more choices. They're not going to want less choice, for the products they want. They want to compare and they want to contrast. So he's like, the second thing I need to do is have more and more choices. Third thing is that people want quick delivery. It's like when you order, he's like, my thing is that how do I make logistics more efficient? How do I make the product go quicker to your place, It's not like when we order food or something, we want it immediately. We're hungry right now, want it after 5 hours or something like that. So he's like, these three things I need to concentrate on: lower cost, more product, and faster delivery. So he's saying that's not going to change ever. So I'm more concerned about those things. When it comes to investing and what are we looking at, so what is not going to change in investing? Partnering with good managements is not going to change. If there's a chore management 100 years back, he's going to swindle you. Today there's a chore management, he's going to swindle you. 100 years from now, chore management is going to swindle you. So partner with great management or good promoters. Secondly, buy low, sell high. Fundamentals matter. So there will be sometimes spikes in sometimes cryptos and all will come, but in the end you need to fundamentals need to be in check. Fundamentals with obviously growth prospects, so that's not going to change. So the way you make money is buying low and selling high, not the other way around. So concentrate on fundamentals, concentrate on good companies. And thirdly, from a business point of view, people, when you're dealing with people's money, they want quicker resolution of their queries, or they want faster transactions. So the other thing is, from a business point of view, is obviously try to get your tech in place and make sure that clients are well serviced, and those are the 3-4 things that we would concentrate on.
So, just broadly speaking, throwing it out there, but what are the couple of themes that are really exciting you going forward? I mean, would it be, everyone's talking about chat AI, we've got big tech investing in it all over the place. Would it be ESG? Would it be, something I haven't thought of? What would be the one theme that's really exciting you as investors, whether it be, globally, whether it be here or overseas?
So in India, we're actually pretty, we like the banking sector, the financial sector, I think that looks really attractive. Again, PSUs after a long time look slightly attractive. And if we could invest abroad, because right now there is a limit that we can't invest abroad, then we would definitely look at big tech to invest in right now.
Okay, so staying on your radar then.
Yeah, I think in terms of, exciting, and this is where, I think things have flipped over the last, 2 years. There's this two styles of investing, value investing and growth investing. And over the last decade or so, growth investing has been the dominant sort of way of, wealth creation for a lot of investors. What was expensive 10 years ago is even more expensive today. And what was cheap 10 years ago was even more cheap. And what we've seen over the last 2 years is that, investing is actually, there has been a certain shift where a lot of these value companies, the PSU stocks, the energy stocks, the utility stocks, have actually come back in a very big way. So I do believe that in terms of what's exciting, what we've seen uncover over the last 2 years is actually exciting is not as exciting anymore. The non-exciting is the one which is actually, done really well in terms of performance, not only in India, but also in the US. In the US, every single, sector is down from its peak since the early 2022, except energy, which is up 60%. In India as well, if you look at the sector profile, a lot of these, stocks which were labeled junk stocks, say, 2 years ago, have done astronomically well over the last few years. So I do believe that, there has been a certain shift. And in terms of, going forward, it's really hard to say, which sort of camp is actually, going to do well over the next decade.
Interesting. So if you had to diversify within, your pickings in the overseas market, would you be choosing between some of the other sectors? Would you be looking at energy? He's clearly big tech. Right? How would you break it up? I'm just curious.
Yeah. So, as a mutual fund house, when it comes to our international funds, we're purely passive. So, and I think passive makes a lot of sense, even to me, because, I think it makes the selection a lot easier. For investors who are looking to diversify internationally, you don't have to worry about, which stock to buy, which stock to sell. It's coming at you at a very reasonable cost. And it's something which has been there for, half a century. The first S&P 500 fund was launched in the 1970s. Its track record goes back almost 100 years. So I think I head passive funds at MOAMC. And the reason why I like, investing in passive funds is because mutual fund has simplified stock investing, but passive funds have simplified mutual fund investing. And I think the simplest way to wealth creation for most people ends up becoming the best. So I think, especially when it comes to internationals, because there's, hundreds and thousands and millions of options out there. So I think, and also I think what we've learned over the last 10 years is that information arbitrage is also becoming a lot harder, especially in the West, not yet in India. So I think really keeping it simple is what has become a default and a very good strategy for a lot of investors.
Do you think, Prateek, that we are going to see a recession in the US? What's your call on this?
Yeah, I think in terms of macro fundamentals, what's funny is that, even my reading has been diversified, so I used to read Indian news now, and now I feel like, reading The Economist and FT has become a lot more value accretive because a lot of changes in the West now impact India. But in general, what I've seen is, and this is from my readings, is, when you see interviews of CEOs in Davos, there is this, sort of a lot more, the body language is a lot better from where it was last year. I think in terms of, just simple macros, I think, interest rates have sort of, at least long-term interest rates are now, plateauing, which is great. You have obviously had inflation, which was also, coming down. I think China was a big problem point last year, even that's sort of opening up. And also the global supply chains, which was an issue last year, is also sort of, loosening out. So, and also Europe's energy problem is also going away. So overall, you could see a much better body language from a lot of them from my end. I think that's, and I would say they're in a slightly better position to see what's coming than we are. So I think from that, I could say that we're definitely in a lot better position today than what we anticipated a few months ago.
Okay. And if I had to push you, Neil, and I know you may not want to talk stock specific, but if you had to choose one of the FANG stocks or any of the tech stocks, what would be your favorite and why? Even if it's beaten down today, but you're like betting on it coming back.
Yeah, I think, I won't give you one, I'll give you three. Okay, so if I had to buy personally, and I don't know what the fund will do and all, but if me personally, I'll probably buy Google, Microsoft, Amazon.
Awesome. all the three big ones. Okay.
What about ChatGPT?
What about
That's too early.
ChatGPT? Oh, it's clearly on everyone's radar. We're going to be hearing about it sooner than later, I think. 10 billion, right? Microsoft just put in.
Yes.
Yeah,
So it's not going away anytime soon. Gentlemen, thank you so much for joining us. A big round of applause. And hope from this conversation that everyone takes away to remain invested somewhat in the overseas markets. Thanks so much.
Thanks.
As we reach the culmination of a fantastic summit today, some of the biggest voices in the stock markets sharing with you how to really chase alpha in a VUCA world. Just making sure my guests are in the room. Okay. Okay, could I request everyone to take their seats, please? And if we could close the doors so that there's not too much noise at the back. If everyone could please take their seats, I'd really appreciate it as I look to welcome our next session. In conversation with Ridham Mukherjea, Global Business Editor at the India Today Group, I'd like to welcome at the Market Today Summit, Ramdev Agrawal, Chairman and Co-founder, Motilal Oswal Financial Services, Shankar Sharma, Founder, GQuant Investec, and Nikhil Kamath, Co-founder, True Beacon and Zerodha. Welcome, everybody.
Good evening, ladies and gentlemen. Now we come to the meat of it. Through the day, you've heard lots of things about the macro and all of that, but this is what you've come to hear, how you make money and how you beat the market. Three very experienced practitioners of all that with me. I don't need to introduce them. Ramdev, Shankar and Nikhil, all of them you know very well. Nikhil's the youngest, but he's been remarkably successful with Zerodha over the last few years, so my hat's off to him for what he and his brother have achieved over the last few years. He's also the most handsome man on stage of all of us, by quite a distance, though Shankar would dispute that. But Shankar, what's going on? In the last year, 60-70% of the PMSs and the mutual funds who investors pay 2-3% a year to manage their money have underperformed the Nifty. When you ask them what's going on, sometimes they say, last year they said because it was commodity stocks and we don't own commodities. This year they're saying because they were those rubbish PSUs and we don't own them naturally. What's the right way to look at it? I mean, it's only when their blue chip HDFC Bank does well, they are expected to beat the market? How do you explain this kind of underperformance? The lack of alpha?
Yeah, so last 12 months, I think it was Adani Group which was the problem area.
Nobody had them.
Nobody had them. And to be fair, let's be fair that fundamentally a lot of the stocks that did well, particularly this group, could not be justifiably held in a fund structure. You could hold it in your personal investing because, it's okay when then they go up 10 times or maybe 20 times. But there is no real, if you say fundamental on the ground reality because of which these valuations were deserved. I'm not disputing that that figure is incorrect. All I'm saying is justifying that for a fund manager to his shareholders, to his investors, to the unit holders, to the regulator, if something were to go wrong, becomes a major problem. So you cannot play every game that is being played in the markets. It's not possible. So to be fair, the underperformance has come because of this one major factor. The Nifty has done better because of this. If you look at the difference between the Nifty and the small cap, that itself is telling you a lot of things. That small cap on an index level has not done as well. So, but the fact is there will be something that will do very well. People are underinvested. And the law of the market is very simple, that the money gets made where people are least invested. And there is no real reason why you should be investing in the least invested. But usually that's the place where you end up making most of the money. And unfortunately, the incentive structure for a fund manager is geared towards retention of assets and hopefully some growth. It is not really a structure in which you're being paid to take a fair amount of risk. And that stems from the investors into fund or PMSs. And I can tell you, I've run these structures, and investors are the worst enemies, I can tell you this, because what they want is an impossible set of combinations. They want you to beat the market, they don't want you to lose money when the market falls, all in the same stock or the same group of stocks. That's not possible. These are impossible objectives to manage at the very same point in time. It's not going to happen. Right. And which is why you will find an odd fund which took the bet, let's say on Adani or in commodities, they will beat the daylights out of the market for a year. Okay? Whether they'll repeat it or not, who knows. So the short answer to your question, Udayan, is that it's been a very tough environment in an organized form of fund management. Very, very, very tough. The headline index is not telling you what the underlying trade change has been. HDFC banks or levers or Asian Paints, they have been dogs, while the underdogs have become the big dogs. Welcome to the markets.
Yeah. Ramdev, what about this trend of public sector stocks, which did very well? And many fund managers traditionally have not owned these names, the Coal Indias, the Power Grids, NTPCs. What do you do as a fund manager when you see these kind of stocks coming back and beating the daylights of your core blue chip holdings?
So it's a problem in the sense that the markets are markets and...
Is your mic working?
Yeah.
Yes. You have to hold it closer.
Yeah. So markets are markets, and they will go, like, one of the things which is happening is that because of sustained fall in the interest rate for last 10, 12 years, there was a method in the madness in the sense that all kinds of growth story, whether it is profit making or not profit making, they were going through the roof. Just 12 months back, we were talking about Zomato and Nykaa and all. Today we are talking about public sector bank. Just see the contrast. What do you expect? Fund manager cannot move 1 lakh crore from, I'm not saying that Zomato and Nykaa, but say from Avenue Supermart or Asian Paints and all those bluest of blue chips to, so that's not the mandate. I would say that it is impossible to do it. So, but that's what market has done. So I think there is somewhere very deep, I'm all the way growth investor, good time, bad time, but clearly somewhere value is asserting. There is a very strong value rally right now. Maybe it was overdone on growth side, and even the decline in the interest rate was also overdone. So, like whatever the pendulum is swinging from that 18%, 10 year in 81, 82 to literally zero to now maybe 3-4%, but definitely not -20. So from 0 to maybe 3, 4%, 5%. So there is a clearly change of cycle there. And we are still struggling with accepting it. What has happened. But even now, today, the same companies are still cheaper than your growth companies.
True. Nikhil, is it driving local investors?
To add here, as a follow-up answer to your question, Udayan. In the 90s, I mean, most of us were born in the 90s in this business. And a lot of the mutual fund managers who have great 25-year records, who became CIOs and then some of them retired, I can tell you one thing. A lot of the performance actually stemmed from 4 or 5 years from 95 up until 2000. And I'll tell you why. I'm talking the index beating. Because the tech sector, the TMT sector, okay, Infosys, Wipro, Z and all that, they did not have any participation in the Sensex. Okay, so the Sensex actually did nothing between 96 and 2000. If anything, it was probably down a bit. But everybody had tech. And they beat the daylights out of the index. Okay, they beat it by like 10-20% points every year. Now that put performance points into your bank, which you ate off for the remainder of your career for 20 years. So you cannot complain that, look, the market is moving in a direction where I am underinvested, because you were in a underinvested area which was not in the index, that did phenomenally well, beat the market. The market did not have those stocks in the index. So, the market cuts both ways. I mean, so we cannot really complain. I'm just pointing out historical facts so that we understand that the markets usually are a tricky place to be in, and we can't just make 1% for doing nothing.
True. Nikhil, is it driving a class of local investors towards passive investing? Because they look at the index and say, I pay 0.2%, just buy the index. And that's good enough from these fancy investors you pay so much money for to manage my money. Is that a fair point, or do you think active investment will actually beat passive investors in the medium term?
So, Udayan, it's a tough answer because we have an active management fund.
I know.
If you look at it historically, I think passive has done better. That 1-2% a year, if you were to compound that over 20 years, mathematically, I think it is quite hard for an active fund to beat a passive fund. And
even in India. People think it's in the US. In India, it will be different.
Well, if somebody is charging 2% every year for 20 years, that's a significant portion of your corpus. That being said, I think active does better in flat markets or range-bound markets, and passive probably does better in trending markets. Considering how expensive the markets are today, relative to the rest of the world, maybe there is a case to be made why active could do better in the next 2 or 3 years when Nifty doesn't give stellar returns. But over a long term, I think passive will continue to outperform because our fee structures are not efficient enough. I don't think anybody can really bring in alpha for a client charging 2%, having a distributor in the beginning who charges a fee and an exit load and all of that. I think it will be quite hard in that model for active to actually outperform.
That's remarkably candid of you to say it because you are in that game yourself. Are you doing something to disrupt that or change that?
Well, I would say we are trying, but I don't think we're doing anything significantly different to warrant a change to kind of, weigh the scale more towards the active narrative. We are charging much lesser and stuff like that, but I don't think that one thing is enough because we're still charging maybe 10% of carry, and to get that much alpha is quite hard over the long term.
Shankar.
I'll tell you one simple golden formula to beat the market as an active fund manager, okay? And that is if you get the bear market right. Because your biggest alpha will come when the market falls 40 and you're falling only 20 or 10. In a bull market, you will not be able to beat the index. Impossible. And therefore, if you have the skills to get a bear market right, and you fall half the market, you fall 25% of the market, you have put 20% point in the bag, and then you will gradually fritter it away over a 3-4 year period to still end up ahead in the game. And which is why it's an underappreciated skill to get the bear market right. Okay? And bull market, ultimately bull market, most people will have similar stocks. It's very hard to be away from, the consensus trade. So therefore, the skill where you can add value as an active manager is to get the bear market right. And occasionally, if you get that right, and I think every 3-4 years you will get a down year, just make sure you get that part right.
When is the next bear market according to you, Shankar?
I don't think it's happening anytime soon, which is a problem for active managers. Okay, it happened, 2 years back, in COVID. Now, if you were alert enough, you could have seen that. I mean, it was not difficult to spot that there was some degree of fall coming, not a bear market, maybe not a huge bear market, but I think from February 2020, there was enough data, and the screen was telling you from Japan up until Italy, schools are closing down and everything. I mean, that was not like a SARS virus. It was very clear this was a catastrophe, a calamity, and they would have some impact. So if you positioned yourself through some hedges, or if you could short in your structure, I think you would have made significant alpha. Right there, in a month, you could have been up 20% relative to the market, if you were smart enough to do that.
Ramdeo, you've had a very long career in the market. How do you do it? Because every year, there is some distraction. Sometimes it is digital stocks, which you may or may not own, which are going up. Sometimes it's commodities, which are having a bull run, which you may or may not have. Do you just say, I forget the noise and stick to my 20 stocks, which I know? Because it's easier said than done, right?
More like if you ask me personally, I'm more like a prop investor who doesn't care so much about 12 months appraisal, and I'm buy and hold. And the longer run, if there is in the QGLP framework, if you have bought good quality stocks at reasonable good price, and your holding period is long, see, even if you get the price wrong to start with, but if your holding period is 10, 15, 20 years, then what happens is that even if you have paid a little more, it doesn't hurt. The growth G is equal to R. That's what I practice, and it used to work very well. But what has happened is that the kind of stock prices we have seen in last 5-7 years, even today, is absolutely absurd. We used to get good stocks in 90. Our problem is that we have seen 40 years of the market, and we have seen Asian Paints at 17, 18 P multiple, and we didn't want to pay 15, 16. That's the kind of history we started with. Then it became 22, 25. Now you are talking about 80 or 100. That doesn't fit into my psyche. So that's a bigger challenge. How do you buy at 80p and still make money? That doesn't work with me.
I know, but sometimes does it lead to you making mistakes? Like last year, you did buy some digital stocks. Do you regret that? Was that a mistake?
Yeah, that was a clear mistake.
Which one did you buy?
I bought Zomato.
Only Zomato?
Only Zomato.
If you, on hindsight, would you have bought it, or you should not have ventured?
I should have not even bothered. See, actually, I don't bother about any IPO.
Why did you buy it then?
But my fund managers, they were on my head. They were telling me, sir, use your office to get some allocation. I'm telling you, this is the truth. So, then for me also to pick up the phone and talk to the company, they convinced me, sir, this is a terrific thing. So that's how, and then you get sucked in. One guy, two guys, they have better degrees than me. So, you start, and then environment is like that. There's so much of demand. The management is worshipped. They don't come to Mumbai. They have to come and meet. They don't even declare quarterly results properly. They have their own formats. All kinds of nonsense. And still you get into that. See, that optimistic market, you get this. Last time in 2008, I got sucked into Central Bank of India. Can you believe this?
Central Bank of
India?
Central Bank
of India. At the peak of 2008 boom, I ended up buying Central Bank big time. So you get sucked in. Because then right now nobody wants to believe PSU Bank. I'm telling you, in 2 years' time, the most coveted blue chips will be PSU banks.
Will be?
PSU banks. Because there will be sustained performance. This is a credit cycle. Credit cycles are 3, 4, 5 years. This is the most reliable cycle. If there is one, any cycle which is reliable is credit cycle. So 3, 4 years, once say it has started turning around. We have only published a report, Motilal Oswal has published a report, where they are saying that PSU banks, they made losses 2 years back. Aggregate, they made 10, 15, 20,000 crore losses. And I think 24 or 25, they are predicting 1 lakh crore plus profit. Now, market is not going to be, they won't be discounting at 5p multiple only. So 5 goes to 10, and the earnings come to 20, say 15-20% also. You see what kind of stock performance is going to there.
Okay, that's a stock record right there. Nikhil, what do you do with the problem that Ramdev just described? Because, you know, I've heard you talk about that as well, that some of these valuations you cannot just justify. Yet, Asian Paints goes from 50 to 60 to 70 to 80 PE multiple. As a fund manager, how do you look at that when you see this explosion in multiples happening?
Well, it's hard, Udyan, but I think these valuations correct from time to time. Maybe not inside of a 10-year cycle, but longer than that. For a fund to have the freedom to kind of have a higher allocation to things like debt and commodity, I think become increasingly relevant. Mm-hmm. So when you see valuations are so high, if I have the freedom to have 50% into debt and commodity, for example, I think that helps a lot in catering to this particular problem. But like Ramdev was saying, I agree with him. Many times I think we are forced to take some kind of an allocation or participation because there is pressure from investors on the fund. But I guess because of what happened last year, I hope people wisen up this year and next year, because I don't think the retail will treat them so kindly when they come into the market with not too much profit but crazy valuations.
But I remember you did not make that same Zomato mistake last year. We spoke once and you said at 125, there's no way, gun to my head, I won't buy that stock. Have you changed your mind at $50 to Zomato?
Well, I still haven't. See, I'm also a part of the startup ecosystem, and I kind of meet and know most of the unicorn founders, and we all hang out and stuff like that. This problem of not being able to raise money at the valuations of last year, I think we're at the very beginning of the pain. I don't think we have seen it yet. The cost of capital for a foreign PE or VC was probably 2% last year. Today it sits at 6%, and their risk-taking ability will totally be changed by virtue of that. So there will be down rounds. If people in America are firing 10% of their workforce, and I'm not talking about companies that are not profitable, but companies which are in some cases sitting with billions of dollars of cash on their book, if that is going to happen there, it will also happen here. I think the timing is something one cannot call. So I think the next year or two will be reasonably hard, not just in the West, but also in India.
Shankar, you're about to launch... No, I will ask you about tech, but I want to ask you more urgently about the stuff that you're getting into now, which is small caps, which is what people want to hear about. Do you think in this kind of environment, small caps will end up beating large cap blue chips hands down? Your fund is going to be largely a small cap fund, right?
Yeah, no, the fund is different. Fund cannot do only small cap, because I've always believed just investing in small caps is like joining the mafia, right? It's very easy to enter, but it's impossible to exit. So you have to be very, very careful when you talk small caps. There are all kinds of companies out there, and I was in Dubai, on Sunday, and I thought Sunday was going to be a relaxing day, and I ended up having 5 meetings with 5 small cap promoters on a Sunday.
Indians?
In Dubai.
No, Indian promoters.
Indian promoters.
All of them.
In Dubai, who had come to see me, and they said, Sunday ko, yaar, Sunday ko kam se kam aaram karne do. I was catching a flight for Bombay that night. So there is this all kinds of promoters crawling out of the woodworks. Each one has a great story. But I can tell you many will fall by the wayside, and therefore it is a very treacherous area of the market. I just want to be very clear about it. However, my view is this, that yesterday's story is over, meaning your Asian Paints, HDFC Bank, Kotak Banks and all that, they are not going to give you any money worth the while at all.
Not even beat the index?
No, I'm 100%. I've been clear for the last 2 or 3 years. Okay, because there was enough data to show that they had run out their course in terms of valuation expansion. And now, even if they grow, the multiples will keep compressing instead of the multiple remaining constant or expanding. Okay, so I've been very clear on that trade. And, some of the numbers, HDFC Bank, not bad, but the market is already saying that, I've had enough of this. So the trade has changed. Fund managers may or may not change, but the trade has changed. right? So small caps is where money will get made. It is also the place where you'll get taken out to the cleaners for sure. So if you want a simplified back of the envelope advice, buy 50 of them, put 1 or 2% of your investable capital into each, and then hope that 5 of them will become 20x or 40x, which statistically will happen. It has to happen. That's the way the game works. If you think each of them is going to be 20x, forget about it. Many of them will become reverse compounders, meaning at the price you bought, they will keep halving from every price till they go to zero. And, you know, you will see that happening. But I just wanted to add to what Nikhil was saying, and the venture capital ecosystem has distorted the whole spectrum of IPOs, of valuations, everything. And we saw that story 22 years back in the dot-com boom as well. That time people had a website and hence they got valuation. Now people have an app and hence they get the valuation. Okay, but there is nothing in the middle. Okay, so I was looking at the data, broad, back of the envelope. Which are the greatest companies in the world? And first of all, why do you call a company great? Okay, in my view, there is only one metric that defines a company's greatness: sustained long-term returns to shareholders. There is, you can make money, lose money, free cash flow, not free cash flow, ROE, nobody really gives a damn. Agar 10-20 saal mein you are compounded 20% plus, you consider it a great company. Now look at the history. Apple listed in 1985. I think Microsoft listed around the same time, a year later. Okay, they were in their infancy. They were virtually in a garage or just outside a garage. Tiny companies. They listed right there. Amazon listed 1996, within I think 2 years of starting the bookstore. Okay, very early in the journey. Infosys listed 1994, almost like it was still a startup in every sense of the word. Correct? HDFC Bank, it listed when it was Worli and a few other branch offices. That defines how much returns your stockholders make. And all these are great companies in hindsight because they listed very early in their corporate journey. They did not have venture capital coming in the middle, providing the unlisted capital, whipping up the valuations, and then IPOing out when the businesses or the growth cycle was kind of coming to a near peak. And they distorted the entire return spectrum by capturing the return from start to the midpoint for themselves and then leaving the stock market, the IPO market, to fend for itself by listing those companies when they've already more or less sucked the juice out of the returns of those companies. So my view is that small cap investing, I am saying to every promoter who's got a good business model, please list as early as possible. Let the retail be your venture capitalist. In which case they will lose money in some, but the 20-50 Xers will come out of those because what is being taken away by the VCs should now come to the retail investor.
Fair enough. Okay. Ramdev, how do you go about investing in mid caps and small caps? Because that is what causes such a lot of excitement for the retail investors. You've had tremendous experience with successes, but you've also had your failures. Can you just give us 1 or 2 examples of mistakes you made, what are the ones which really worked out, and what you took away from those?
Yeah. Then, what I've seen in last 20, 30 years is that the opportunities come. See, you have a framework. I work with the framework. I have a framework. I'm looking for a certain story to build up. And say, I saw first time mobile phone and I was damn excited. It's a network business. I had read a book by Michael Mobison and how it is going to work. Now, I was looking for a network business opportunity in 2003. And Bharti came with IPO at $45. Immediately they bid it down to $19 because it was making losses. Same situation like what is happening now. So they bid it down to 19-20. We didn't know. I was very clear at 45 it is useless company. So the banker was known to me. He was saying, you guys don't know how to value a mobile company. At that time, mobile was a new frontier. So I said, you guys don't know how the stock market works. यहाँ जो दिखता है वो बिकता है. आप प्रॉफिट नहीं कमा रहे तो हमारे लिए जीरो वैल्यू. यू आर यूजलेस. मतलब डोंट टॉक टू मी. आप करो जो करने का है. Then in 2003, Sunil Bharti Mittal announced we are broken even. Then you could see it's a quarter on quarter 25-30% kind of growth. So I'm all the way growth investor. If I can find a company in mid cap, mid cap is a good place to start. Small cap is they're small because they need to be small. Kind of useless fellows. So like they cannot think of big. I mean, HDFC Bank, I know, I was the first investor at $40 when 1,000 crores market cap was there. So, very small is, I would think, they will never make it to the big board. It is the mid-sized companies like iShares, your Bharti, or even HDFC Bank. When it started, I think it was less than 100 rank company on day one. Infosys at 400 crores or 500 crores they started. That time it was a little obscure in terms of software, but still they were not that small. I mean in 93, 94, to have 400 crores market cap was good. So I think we should start somewhere at the mid or something like that. And there if I get a story which I think, because I read the paper every day, it is a surprise to me that this kind of story can build up. Return can be very high. That's where I think I have made money, and I think there are enough stories.
No, one mid-cap mistake you made, just to illustrate to the audience what you should not be doing. A recent example of a mid-cap mistake that you made.
So I told you...
No, that's digital. That's a different league. I mean, regular company.
Yeah, so there was... I don't want to name the companies, don't like it.
Come on, you just said...
Okay. So I got the story of Sterlite Technology. When
Sterlite Tech, okay.
Yeah, Sterlite Tech, when it was making only that digital cable. What is that? Optical cable.
Optic fiber cable.
Okay, and there was a boom globally. I didn't know the difference between commodity and consistent companies and those kind of things. And it was seriously making a lot of money. I heard about this story at $100. By the time I could make up my mind, it was $300, and by the time I bought it, it was 500 rupees. The moment I completed the buying, so don't chase your stocks too much. You know, so the moment I bought, I saw a price of 750, and before I could enjoy, it was again dropped to below my purchase price. And by the time I sold it, I must have sold it 50% loss. So and now I think the fight is even more deeper. Cost of getting entered into a smaller company is extremely high. And if by chance you go wrong, then you are completely cleaned up by the time you get out. And particularly when you are running public money, it's a nightmare. Yeah. If you're running a private money, still you can pace it up. Your quantity will be small. So I think audience, if they are running private money, perfectly all right to do small cap, even small mid caps. It's actually, that's the place actually they have the advantage. The upper side is so intensely researched. I mean, the managements tell us, I'm telling only to you. Okay, when you come out of the room.
In front of a few hundred people, it's all right.
So when they come out of the room, the next guy says, this is what he told me. So everywhere he is telling the same thing. I'm only telling to you. So you have no advantage in the large caps. True. Even management is trying to give you something which he doesn't know about the company. And it's already priced in. So I think, guys, we have to be very careful when we are buying very large cap. It is better that fund managers only battle it out day in, day out. In mid and small, you have a great chance to be ahead of the market because that is not being researched.
Nikhil, what's your recipe for creating alpha? Because there are various approaches. Some say you must have a long-short approach. You buy some and you short some. Some say do a multi-asset play that will smoothen out the rough edges and you will create alpha. What's your strategy?
Well, what we've been trying to attempt is the multi-asset class approach. But to be candid, Udayan, I don't think there is a recipe because we haven't figured out how to do it yet.
Okay.
What we are attempting to do is take advantage of many discrepancies in the market to try and create as little as 20 to 30 bips of alpha a month. That's what we set out to do. We've largely done that over the last 3 years, but we've been able to do that because markets were not as efficient then as they are now. And progressively, as they get more efficient, it will get harder for us to find that alpha. We also have a mandate that we stick to large caps alone. Unlike what he was saying, Mr. Ramdev was saying, I find it easier to invest in large cap companies because I do not have to worry too much about the compliance and governance aspects of them. When you go to a smaller company, you need to put in incrementally a lot more work and you will still be wary of whatever is being reported is above board. So I recommend that, investors as well, whenever you're looking at companies, stick to something that 100 other people are researching because if something has to be caught, is probably caught by then.
Except in Satyam, they all never caught it. Don't you remember?
Yeah.
No, but the thing is, I mean, I agree there is hopefully better governance in the larger caps, hopefully. But, the fact is, we will make money where there is danger. Where there is extreme safety, there is no money. It's well discounted, everybody knows it. And frankly, I think the biggest marketing success in Indian fund management has been that of a fund which marketed HDFC Bank, Asian Paints and all these old stories as something absolutely new and gathered.
He was here this morning.
I believe so. And gathered AUM when people are paying you money to buy HDFC Bank and Asian Paints. I don't think that the bigger set of idiots in this whole planet. Trust me. I mean, it's absolutely ridiculous. These companies are well discovered. They have great governance. They have great ROEs, great cash flows, great everything. And why should you anyway pay somebody to put money into those and only those? If you're putting that as part of a larger, little dangerous companies also, I can still get that. But just in those 10 names, I really don't get it. So the fact is there is danger wherever there is money. Okay, and that is what we are getting paid to do as professional managers, to sift out the least dangerous of this lot. Because if you just completely avoid them, then so many companies were small caps back then. Okay, in the 90s, which became huge companies. They are missing out on that chance to get the next Infosys or the next Bharti also.
Sure. Nikhil, what's the current strategy? You were going to tell us what are you doing right now to create alpha?
So, Udin, honestly, to second what I was saying earlier, we've reduced our equity allocation a lot.
To how much, roughly?
To about 37%.
That's it?
Yeah. We've increased gold considerably, about 10-15% gold, and the rest is in debt. Nowadays, you're getting AA paper, reasonably good paper at around 9%. If one were to assume stock markets traditionally give out about 10-11% a year, you really ask yourself, is that additional 2% worth all the volatility and all the chaos that comes along with it? So we have a larger chunk than usual in fixed income right now.
Okay. Shankar, one tenet of investing for many Indian investors is exactly the opposite of what you're saying. Basically, buy the blue chips and forget about it. In the long run, you'll be okay. But you're saying that will not necessarily work in beating the market.
No, I'm not saying it's either or. I'm saying you can do both. You should have a decent allocation. I'm not saying what is a blue chip is all up in the air anyway. A blue chip, in my view, that makes money for investors.
So Asian Paints, HDFC Bank.
They are good company. They may or may not be. I might want to buy their debt instead of buying their equity. But the point is very simple. It should not be an extremist approach that I'm going to buy only those and not this, and only the small caps and not the large caps. Ultimately, it's about balance, and balance will give you stability. It will not blow out the lights. Let's be clear about it. And investing, in my view, on a fund basis cannot be about blowing out the lights. It's about staying in the game without getting really injured in a bad. On my prop side, I'm willing to take that risk. I'm willing to meet 5 promoters on a Sunday and, lose money on 4, but make in 1, almost like a VC approach to investing. But on a fund basis, it's impossible. Nobody will, you will get killed if you were to adopt that kind of strategy.
Right. Ramdev, you just spoke to us about public sector banks, that the credit cycle is starting, next 2-3 years will be great for them. But we know that these credit cycles, they make a lot of money, but it almost always ends quite badly for them. After 3-4 years, there might be trouble again. I want to ask you about selling. How do you decide when to sell a stock and get out? Because everything is cyclical. It does well for a while, and then there is a time to sell it. Contrary to the theory that you should get married to the great stocks forever. When do you sell? When will you sell your PSU banks?
PSU banks, the moment it doubles, get out.
Just double?
Yeah. You have a price target. Double, 50%, whatever, in 3 months if you get 50%, run. Because this is not buy and hold, for sure. This time I realized that buy and hold has to be the consistent companies. The companies which have a terrific track record. I think what we invest a lot more on trying to understand the future. Actually, we should spend 2/3, 70-80% time in trying to understand the past of the company. And past tells you a lot more about the future. Because future is uncertain. Very few can predict it. In fact, the entrepreneur himself doesn't know. You ask me what is the future of my company, it's very tough. Future is bright, for sure. But if you ask me a specific number, I can't give you. Actually, I don't have a number. So that's the case with all the entrepreneurs. They have very little knowledge, but unless they think that they know everything about future, without bothering about the past. Past has been completely wretched. They have not made money. Return on equity have been 2-3%. Pathetic track record. But from here onwards, it is going to make in their Excel sheet 25-30% compounded. And that's what we buy. So I think from here onwards, I'm going to focus a lot more on knowing the company's past. Not that I was not knowing, but even the companies I was holding, I was not knowing enough. So I think one message is very clear. Please know in every aspect of life, you do a lot more study of the past, for the marriage, for the hiring a manager. You look at the only past. Because the manager is going to say, I'm going to do all the wonders. So...
Okay. Shankar, what's the next couple of years going to be like for the market, you think? We've just come out of a very ordinary patch last year. We did better than the rest of the world, but returns were average. What's it looking like from here?
No, I think if I look at the world and just go analytically from Japan down to South America, there are very, very few markets you can make sustainable money. And about the only market I see is India. And of course, I look at, I see Turkey as being a decent bet. I put a lot of money there and hopefully...
In Turkey?
Yeah, I've made a good amount. Actually, the index there is up 60% in dollar terms this year, by the way. It's beaten the daylights out of the Nifty. So it's been a good trade. So I mean, again, now there is danger. Everybody I talked to about Turkey said, "Tu pagal ho gaya kya sala? Ye koi country hai kya? Inflation 85%." I like such stories. Okay, I like those are the places. There's a lot of danger. So you will make some money there. So, but otherwise, I can tell you the mantra in investing is this: you have to be able to time the markets. You have to be able to time the cycles. You may remain invested, but invested in what? That's the key question. Sometimes stocks will do well, sometimes commodities will do well, sometimes your blue chips will do well, sometimes small caps. You need to be nimble. Fund managers are lazy. They are busier looking at asset gathering as a profession rather than being actively involved in understanding market cycles. And very few fund managers get that. I've been in the business long enough to know. Cycle nahi samajh mein aata inko. And that is where the problem of alpha generation lies.
Nikhil, last word with you. The few times I've spoken to you over the last year or so, you've sounded more circumspect than most of the others I speak to. I mean, they say India is a great story, bullish. You sound a bit more bearish. Why? I mean, are you still like that or have you changed your view?
I'm still like that. I think it's a disservice to people when everybody on TV always says bullish stuff, If I were a retail investor looking upon a TV channel for some advice, and everybody is constantly saying, buy, 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 and I'm not talking today, but every year over the last many decades, it's the same story. So if nothing else, I think one voice on the other side is useful. But outside of that, on a relative basis, I find more opportunity today, say, I'll give you an example. Meta in America at 13, 14 times earnings probably looks more attractive to me compared to many of the tech stories in India. And if one were to truly argue, they are spending a lot more money on research and innovation than we are back home here in India. So I think there are stories like that outside which are available at a discount right now. Like Tesla is probably 30, 35 times 1 year forward earning or 2 year forward earnings. So as an international investor, if I were to be looking to allocate money today, why I choose India when we have not corrected and the rest of the world has corrected so much, I still don't know why exactly I am wagering on India today versus those companies at the discounts that they are available. Everybody says the India story is great, but if you go to another country, the narrative is the same in those countries in their own media, and people are saying exactly the same thing. For that reason, maybe I'm a little bit more skeptical than I have been in the past, more so this year than before, I think.
Great. Lovely hearing your thoughts, gentlemen, and to see you in the flesh after a long time. Thank you very much, all of you. Pleasure.
What a fantastic note to end the summit on with Shankar Ramdev and, of course, Nikhil bringing us all those insights and the constant question, how do we time the markets? Do stay back and join us for drinks and dinner. And I'd like to also thank our sponsors as we close the evening. Powered by Radico, Spirit of Excellence, Exchange Partner NSE, Banking Partner AU Small Finance Bank, Mutual Fund Partner ABG, Financial Technology Partner HECO, Fashion Partner Gabbana, Energy Partner B1, and Digital Media Partner Daily Hunt. Thank you so much.